Well, hello everyone. Thanks for joining us today. Today we have Taylor from Franklin Templeton. He's been in the industry for about 10 years. And what we're going to talk about today is the 2025 outlook of the markets, kind of where we see things going, what Franklin's opinion is, and we'll take it from there. So I appreciate Taylor you being with us today, and we'll roll through some information. Thank you.
Awesome. Sounds good. Thanks for having me on, Matt, and thanks for everyone listening in here. So I guess first, just a quick background in a few seconds on Franklin and what I do with the Institute. So Franklin Templeton is a global asset manager, over $1.5 trillion. We manage mutual funds, ETFs, et cetera, equities, fixed income, bonds, the whole package. And what I do with the Institute, with my team of fellow strategists, is to collect a view of all the portfolio managers, the people who are managing the money, and come up with an outlook on markets, on the economy, where there's key opportunities, where we feel there's risks, and then we share those views as well as our own research with financial advisors and clients. So what I'm gonna hit on today is just an overview of Franklin's views on the economy, on equities, and then I'll wrap up with our views on bonds. I'm not going to talk about, and I never talk about any specific products. I will say that nothing I say here should be construed as investment advice. I always work with your trusted advisors, folks like Matt, to help understand what makes sense in terms of investments, what makes sense in terms of opportunities and risks for your specific portfolio. But I do just want to share some information on where we see things today. And I'll start out with our views on the economy. And I would say, as we sit here today, a couple months into 2025, from a global growth perspective, things are very positive. And I would say that is especially true in the United States, where we're expecting real GDP growth, or the economy to grow, inclusive or taking into account inflation, at 2.5%, which is a little bit, you'll see in the top right-hand bar there. 2.5% is above most estimates from others on Wall Street as well as the Fed. 2.5% is really solid growth, and we're coming off a very solid growth in 2024, where the economy grew by closer to 3%. So in terms of the United States, growth is positive. We expect it to still be positive this year and into 2026 as well, which should be a pretty good backdrop for investments. As we look globally, things are a little bit less strong. If you think about developed markets or areas like Europe, we're expecting growth closer to 1%. Some areas, especially Germany right now, are struggling, and we would see some maybe signs of slight or modest recessions in developed markets. As we look to emerging markets, areas like China, India, Mexico, Korea, South America, pretty solid growth expectations in emerging markets, but nowhere near the level that we saw in the decade preceding the pandemic. Most of that is due to China becoming a more mature economy and also having some weakness here. So we expect decent growth out of EM, but just on a relative basis, as we look globally, the strongest growth engine really is the United States. And again, that should be a good backdrop, all else equal, for investments here in the U.S. The last couple of things I'll hit on the economic side is, one, inflation. Inflation has been a huge story here for the past few years after the pandemic, when we saw inflation move towards 9% or 5% on a core inflation number. We've seen inflation move back down. The Federal Reserve, our central bank, is hoping to get inflation back to 2% on a year-over-year basis. Right now, we stand at about just under 3%. It's our view at Franklin Templeton that it is going to take some time for inflation to return back to 2%. So we see 2.75% kind of being the range of inflation at year end. That's important for us because, again, while it's very strong progress from the super high levels of inflation in 2022, it still is, we recognize that it still is very high for most consumers, and the Fed does as well. So what does that mean for Federal Reserve interest rate policy? The Federal Reserve had increased interest rates in order to try to get inflation under control, and they've now begun to cut interest rates as inflation has moved back towards 2%. So how many times will the Fed cut interest rates this year? In Franklin Templeton's views, the Fed is going to cut interest rates twice, and the very short end or very overnight interest rate should be just under 4% at year end. So the Fed is cutting interest rates. It's doing so at a slower pace than most people expected. Just going back a year ago, when many folks thought inflation was moving down faster and that the Fed could cut interest rates quite a bit more. And now we've kind of landed at 2 more rate cuts this year. And I would say, whenever I end on the interest rate side and I talk about how the Fed is slowing the pace of interest rates cuts relative to others, I think it maybe tends to feel a little bit more pessimistic. But what I would say is the Fed is still cutting interest rates. The reason they're cutting interest rates slower than most people expected is actually because the economy is much more robust than most people expected. A lot of folks thought that the U.S. economy could face a recession last year or even this year, but that is not the case. And the labor market has remained, very, very robust and very strong. So the Fed is cutting interest rates. It's doing so not in a recession. And when we go back 50 years and we look at times when the Fed has cut interest rates outside of a recession, it tends to be very positive for real economic growth. And we expect that to continue again this year. And while the historical average of 4%, might be a little bold in this case, again, I think it is a very good backdrop that when the Fed is cutting interest rates, that tends to be positive for the real economy. The last thing I'll hit on the inflation side is tariffs. We get a lot of questions. We've gotten a lot of questions about tariffs and the impact it may or will have on inflation. When we look back at prior periods of tariff policy, and namely Trump's first administration in 2018, 2019, when he was putting tariffs on, what we found is we look back and to see what was the impact on inflation. You'll see the blue line is goods inflation. These are things that you buy. These are things that would tend to be more impacted, again, by tariffs, as opposed to the green line there, which is services, which again isn't actual goods. So when you look back at the 2018 period, you didn't actually see a big increase in inflation. You saw a small spike, but inflation had actually been increasing in the period preceding the tariffs going on, and they actually fell after. So when we look back at 2018, and if you think that the tariff policy, this time around should be similar to that of the 2018 period, which again I think is our base case, then we wouldn't think that just because tariffs are going on or being talked about that is necessarily inflationary. And of course, the massive spike on the right side there, you'll see goods increase quite a bit. That is in response again to the economy shutting down, the supply chain issues around COVID, and then the resulting services increase as well. And again, you see that start to come down here, but it might take some time to get back to 2%. So that's the economic backdrop. I would, again, just to summarize, very strong, robust economic growth here in the U.S., a little bit weaker growth internationally, and the Fed is cutting interest rates, again, at a little bit slower pace than most people expected, but it still should be a positive. Now, on the equity side, I would say, all else equal, a strong economy there, the Fed cutting should be very supportive for equities. I think the one thing that maybe hangs us up on being super bullish or super positive on equities is that it's been a great 2 years for the stock market, where in 2023, the S&P 500, which is the 500 biggest companies in the U.S., had a total return of about 26%. In 2024, last year, the market was up about 23 or 24%. So very strong back-to-back years. The long-term average or the 30-year average for returns to the S&P 500 is closer to 9%. So we've had way above average earnings or above average stock market returns the last couple of years. And I think that maybe pulled some gains forward for us. So as we think about the stock market this year, again, I think the fundamental of a strong economy and strong earnings growth or strong profit growth is a positive, but things are what we would say is a little expensive here, where profits are expected to grow by 14% on a year-over-year basis, which is, I would say, well above historical averages. We expect it to grow, profits to grow closer to 7 or 8%, which is closer to average. And that means for us, when we think about where we see the S&P 500 ending the year, you'll see the range is 64 to 6,800. Right now, the market is closer to 6,000. So what does that mean for this year returns in our equity portfolio managers' views? That comes in closer to high single digits. So not the super strong returns the last couple of years, a little bit more modest, which again it might be an okay thing. So while the S&P 500 might just do okay, we do see opportunities in specific areas of the market. For us, that is based in the U.S. We like U.S. Equities, we like U.S. small cap, and we like U.S. value especially. These are a couple areas that haven't done as well as the total market the last couple of years. The market really has been driven by growth stocks, or what the industry has called the Magnificent Seven. This is, Apple, Amazon, Alphabet, Meta or Facebook, Netflix, or not Netflix, sorry, Microsoft, NVIDIA, Tesla. These companies have had outstanding profit growth. They've also had outstanding market returns, and they've really led the last couple of years. As we look to this year to date, just almost 2 months into the year, what do you find is the S&P 500 is up about 2.5%. The Magnificent Seven, those again 7 mega cap tech stocks, are actually down 1.5% on average. So we've started to see the market broaden out a little bit, where growth has outperformed value in 7 of the last 10 years. We're seeing value outperform this year, up 4%. Growth is up 1%. So we're seeing the market broaden out outside of just the super concentrated growth. We expect that to continue. So for those who are investing for the long term, those who have been investing in diversified portfolios, we still think that is where you want to be. And well, again, while the market overall might just have okay returns this year, we do think that there are areas outside of the major index that can do well. Again, namely U.S. Small caps and U.S. value is where we're looking at. And then I think to wrap up on the equity section with a key risk, I think the key risk in our view are twofold. First is geopolitical risk. There's a lot going on here. There's a lot of volatility in terms of the news flow, in terms of a couple of wars in the Middle East, in Europe, and there's also I think the specter of maybe a significant trade war. Again, it's not our base case, but if things escalate either on the trade side, where we see really all countries putting tariffs on each other and escalating those, then I think that could cause some issues economically. And then also on the war front, if we see not things trending towards peace, but trending towards the opposite direction, I think that could cause some hangups in equities. And then lastly, earnings coming in a little bit below expectations, where right now expectations are very high for earnings. And of course, we have NVIDIA reporting earnings Wednesday. Expectations are high. If they come in closer to average, that could cause some issues in the market as well. And then a couple of slides here just to show why have growth stocks done so well. We believe that over time, stock prices tend to follow earnings growth, or how much our company is growing their profits. And you'll see since the bottom of COVID, the Magnificent Seven, which is that top blue line, has grown earnings by 500%, compared to the rest of the market, which grew earnings at 27%, and small caps were closer to 8%. So the Magnificent Seven have outperformed by a wide margin, but their profits have also outperformed by a wide margin. And can that continue in the future? We think that returns should be a little bit more modest for the Mag 7. And in fact, we're starting to see the rest of the market have solid earnings moving forward. So while it's been a struggle for they call it the rest of the 493 or the rest of the index, we see that changing. That is seen here when you look at average expected earnings or profit growth for 25, 26. I wouldn't worry so much about the actual numbers here, but just think that the best earnings are expected to come from not the Mag 7 or just growth, but small caps as well. As we look to the different sectors or different types of companies within the S&P 500, you'll see, again, I wouldn't worry so much about the numbers here, but a lot of strong earnings growth expected in 2025 and 2026. If I showed you a chart of the last 2 years, what you would see is the sector earnings were not flat like this. It was very heavily skewed just towards technology. And in fact, a lot of sectors actually had negative earnings performance. And then lastly, we get asked quite a bit about, why has the US outperformed Europe and the rest of the world? Again, in our view, what matters most for markets is earnings. And we look back to 2009, you'll see that earnings for the S&P 500 or for the United States have grown by 200% since 2009 on a cumulative basis. The stock market has returned 500% over that period. If you compare that to Europe, where earnings have only grown 40%, the market has returned, but call it 150%. That really explains it all. Where the U.S. has had earnings grow 4x that of Europe, and the stock market has grown by about 4x that of Europe. So what is it going to take for international to start to outperform? I think it's really going to take earnings to start to outperform. We look at expectations for earnings in the next couple of years. Again, here's how much profits are expected to grow for these major markets. You'll see, India, which has had very robust growth, is leading the clubhouse in terms of our selected areas right here. The 34% earnings growth is coming off a couple of great years of equity performance as well. But really, what stands out to me is the U.S. having such strong profit expectations over the next 2 years, even higher than that of emerging markets as a whole. And again, you'll see Europe there is expected to have a little bit worse performance. So I guess to wrap up the equity section, expect more modest returns this year and moving forward, especially for the S&P 500, due to market concentration and due to expectations again being very high for the Magnificent Seven for large cap mega cap growth. We do see opportunities though in other areas in U.S. small, in U.S. value. We expect the market to broaden out, which for us means not that just the top names would do poorly, but maybe that they might just do okay in other areas that haven't had great performance will start to perform better. So look to broaden, look to stay diversified here in 25 and 26. Onto fixed income, bonds have had a very poor performance over the last 4 years. I think if you look back to 2021, bonds have had the worst 3 and 5 year performance actually since the Great Depression. So why have bonds performed so poorly the last few years? It's been a result of interest rates rising substantially. When interest rates rise, the prices of bonds tend to move lower. And again, we've been in a regime of interest rates moving higher. Our view moving forward, again, is that rates should start to trend lower. We've already seen that. And in fact, we've seen bonds start to perform much better in 2024. And they're actually having pretty decent performance here in 2025. So we do look for those who are using bonds in their portfolios for diversification, for protection on the downside. We do think that is going to be the case moving forward here. And of course, the other reason you owned bonds is for income or for yield. And right now, interest rates are pretty high. We think they might move a little bit lower, but just having a starting point of high yields and high interest rates should be very supportive for fixed income in portfolios. In terms of what areas of fixed income we like, we are attracted to plenty of areas. We like shorter duration fixed income. So, for those who can take a little bit more risk than cash or money markets, we like that short duration part of fixed income. On the credit side, in terms of corporate bonds, we are seeing opportunities a little bit in investment grade, but actually more in high yield. High yield is an area that carries a lot more risk than government bonds or investment grade, but you're getting more yield. And given our belief that the economy is in a good fundamental position and corporate profits are strong, that should be supportive of high yield. Again, it does carry more risk than other areas. And then lastly, we do see munis as being very attractive here, where tax equivalent yields are quite high. And fundamentals in the muni market are still attractive. And I guess to sum up the bond section, and really to just show that how strong the backdrop has been, this shows the high yield default rates, again, for the riskier part of fixed income. This would be true across the board, whether it's munis or whether it's investment grade bonds as well. Default rates are extremely low. Default rates spiked in 2020, 2021, around the pandemic, when a lot of businesses went out of business. And we've seen, really the types of companies that are issuing bonds are much higher quality than they were in the past. And again, I think default rates being low is really a great reflection of just how strong the economy has been the last couple of years, notwithstanding I know that the tough impact that inflation and higher rates have had. So I guess to sum up the section here, it would be to think about fixed income as returning to a very solid and important piece of portfolios. We recognize it's been a tough couple of years, or at least 2 of the last 3 years have been difficult for bond investors. We think with interest rates being stabilized or moving a little bit lower, that the importance of having bonds in portfolios, will be revitalized here in 2025. In 2026. But Matt, why don't I pause there and see if there's anything I missed, or if there's any questions you think I should answer here.
No, I appreciate it. Yeah, you need a little break. That was a lot of good information. It was definitely, I get questions a lot from clients just regarding the forecast of the market, where we think things are going, and from what you have talked about, you're right on cue with what I've heard from a lot of different companies. We're seeing the projections being somewhere in that 7 to 9% range of the markets. High yield debt is a place that might be a way to get some good returns. Small cap should rebound just because it's been so low. But it was interesting. I was taking some notes. Just India, we've looked at it but haven't studied it so far. So I'll have to pick your brain again on that. But I think all the information you provided is right on cue with what we're projecting as well.
Awesome.
Yeah.
I think that the one thing I would end on, Matt, is just that I think we've been reminded in the first month or two of the new administration, just that the news cycle is going to be volatile here, which means I think there's going to be a lot of headlines that could cause anxiety for markets. But I think for us, being long-term investors, what we believe really matters for markets is not necessarily different administrations or different policies. It's really, the markets are really driven by earnings and profit growth and the strong economy. And I think it's difficult it's easy to watch the news, flow and be super positive or super negative, and that can change day to day. But when we think about long-term profit growth, we think we're in a very strong fundamental position. And then, again, there could be some volatility, there could be some sell-offs due to headlines or different moves. I think at the end of the day, if you just return to how are U.S. companies especially performing in terms of profits, they're performing quite well, and they're expected to moving forward. So I think we remind our team and we try to remind our clients that it's going to be a volatile news cycle, and it always is at the start of any administration. And just to look through that and really think about how is the economy doing, how are the profits doing, and again, they're doing quite well.
Correct. And you're 100% right. The media, to their own fault, they're on 24/7, and they've got to fill space and they've got to fill time. And negative news typically sells better than positive news. But when you really dig deep into companies, and think about how they're doing financially, what their balance sheet looks like, what their profit loss looks like. Most of these big companies, the large cap, are floating to the top. And to your point earlier, the Magnificent Seven have done amazing, but certainly diversification is such a key fixture in our practice, where we have to look at all the different sectors that are out there to make sure that you are diversified, because the Mag 7 have done great, but to your point, they're down for the year. Whereas the other sectors, other investment places are doing that much better. So still want to respect them and still invest in Amazon and Apple and all of them, but we definitely want to look at the total picture to make sure that our clients are in the right spot.
Yep, I couldn't agree more there.
And every client's different. So, if clients, if you do have questions, if you want to reach out about your specific portfolio and how it works and how we're set up, obviously we welcome the opportunity to meet again and review, and feel free to forward this on to your friends and family as more information, because the more information, the more education that you can provide yourself, the more comfortable you can be with how the market is. Because to your point, Taylor, there's going to be volatility this year, next year. Most every year there's some kind of ups and downs of the market, but it's having that we're not going to just sell to sell. There's got to be a reason why we're going to sell, and then where we're going to put that money. So we need to make sure we're educated with the investment strategies.
Yep, that's right.
Well, I really appreciate your time today. I know you've got a busy schedule traveling and dealing with family and everybody else. So we appreciate your information, your education, and obviously hope we can connect in person one of these days. And but clients, feel free to reach out if you have questions. We're here to help you and make sure you're comfortable with how you're invested. So thank you again, and we'll connect here soon.
Thanks, Matt.
Thank you.